Hello, this is the weekly Tradecast. I'm Sarah Toms. All this month we're celebrating the 60th anniversary of UN Trade and Development with a series of special episodes. We're talking about how trade and development transforms lives and builds better futures. And we're looking at the big themes that will drive our vital work in the next 60 years. Coming up.
Of course, a lot of investment goes to the more developed countries. A lot of investment goes to the large emerging markets, but there are many smaller and poorer developing countries that get very little investment.
This week we're looking at the UN's latest World Investment Report and the trends that are shaping trade and development for years to come. Global flows of foreign direct investment, or FDI for short, declined marginally by 2% to $1.3 trillion last year. Much of the headline number, the report says, was impacted by swings in a small number of conduit economies, which often act as intermediaries for FDI destined for other countries. Without those drivers, FDI globally would have been lower. Some good news, though, this year should be better than 2023, but risks and uncertainties persist, especially for developing countries that need investment to grow now and adapt in the future. Looking ahead, the report explores how investment policies and decisions are being shaped by technology, sustainability, and geopolitical tensions. For more on the trends in investment and how to ensure developing countries are part of the benefits, we're joined now by Richard Bolwijn. As Head of Investment Research, Richard leads the team creating the annual World Investment Report and other insights. Before joining the UN, he advised many private sector firms on international investment. Well, welcome back, Richard. So to start off, Richard, the headline number in the FDI report is not very positive, but perhaps it's even worse than it appears. Why are we seeing investment trends still on the way down, and what does this mean for developing countries?
Yes, Sarah, thanks for that question. The headline number is minus 2% at the global level, but influenced to a large degree by some conduit economies in Europe. And without that, the global decline would have been even more than 10%, with a 7% decline approximately in developing countries and a 14% decline in the developed countries. So that 7% decline in developing countries is kind of rare. Usually we see an increase there, and in the last few years, inflows in developing countries have been quite strong. And there's still huge investor uncertainty because of various global challenges and crises that we have ongoing, but also because of tighter financial conditions, higher interest rates last year. And those affect, in particular, international project finance in infrastructure industries, which were down by about a quarter. And they affect cross-border mergers and acquisitions, which were down by half in value. And for the first time in many years, we saw a decline in Asian FDI there last year. And that, of course, has to do also with trends that we see now in the global market of global economic fracturing, which affect patterns of FDI worldwide, with lower flows going to East Asia in particular, and redistribution of FDI, especially in manufacturing and strategic sectors across the world.
What are the bright spots then, or are there any bright spots? Why are things looking better this year?
There were bright spots, certainly. The main bright spot that I see is that last year we had an increase in greenfield investment project announcements. So that uptick last year is a really positive sign. And even more positive is that much of it was in manufacturing. And manufacturing investment, greenfield investment projects are exactly the type of projects that developing countries need to build productive capacity, to engage in economic diversification, industrial diversification. So that's a really positive sign. Plus, of course, what we've seen is that while last year interest rates were moving up and financial conditions were getting tighter, these are stabilizing now, so that could also mean that project finance could stabilize or could increase again this year. Add to that, of course, that the companies, the multinational enterprises on which we depend for that foreign direct investment, they still have really high earnings. They report still very high profits, and those can be invested in the coming years. So that's why we think that an increase this year is possible.
What do these shifts in trends actually mean to the average person or the small business owner?
Good question. If I think specifically about small business owners in developing countries, right? They depend on international investment for the arrival of large multinationals in manufacturing sectors to which they can supply their products, through which they can access international markets or even act as a supplier within their local markets. The problem we have seen over the last decade of declining trends in greenfield projects in manufacturing is that it really affects the way developing countries, especially the poorer developing countries, and especially small and medium-sized enterprises in those countries, can take the first steps on the what we call global value chain development ladder, right? Usually that ladder moves from natural resource type projects to basic manufacturing, to more advanced manufacturing, to higher technology sectors and to services. That's the sort of development ladder that you normally get through foreign direct investment. And with fewer projects in these basic manufacturing sectors over the past decade, that ladder has become more difficult to climb for developing countries and for SMEs in developing countries. We are hopeful that with an uptick in manufacturing investment, that process is starting to get reversed.
In a climate, as you said, with so many challenges, how do we get investment back on track, and what should developing countries be doing to attract that investment?
The decline of flows to developing countries that we have seen is certainly not because of a lack of policy action by developing countries, right? If we look at investment policy measures over the past year, you see that in developing countries, 85% of these measures are aimed at attracting more investment. Whereas if we look at developed countries, many of these measures are aimed at regulating or restricting investment. So developing countries are really still doing everything they can to promote and facilitate investment. That facilitation part, investment facilitation, is really at the forefront of policymakers' minds in developing countries right now. We see a lot of measures at national level, such as one-stop shops to make life easier for businesses to establish themselves and to operate in the host country. And we see also international investment agreements more and more containing provisions aimed at investment facilitation, easing, providing information to investors, making rules and regulations more transparent, streamlining administrative procedures. Those are the kind of measures that are being taken. Now, in our report, we explore this quite in depth, and because these types of measures are all about providing information, they're all about transparency, they're all about streamlining of procedures, digitalization is obviously a key aspect of this. So there's still work to be done. The good news here is that because in the poorest countries, there are often fewer legacy systems that need to be replaced or integrated. It can be easier for them to leapfrog and to move straight to the type of online digital government tools that the more advanced countries might develop. So it can be done. It just requires a lot of support and technical assistance often.
Right. Now, a big topic in the report is sustainable finance. What are the forces shaping the policies and the markets around sustainable investing, and how is this helping with the Sustainable Development Goals?
Sustainable finance is still growing, right? If we look at sustainable finance market in global capital markets, it's still up. The green bonds and social bonds, but also the investment funds focused on sustainable development are still growing in value. But we can see the first signs of a slowdown, right? So while the asset base is still increasing, the inflows, the influx of new funds in sustainable funds last year was much lower than the year before. It moved down from about 160 billion to only 60 billion of new funds last year. So there is a first sign of a slowdown there. Of course, part of that has to do with the overall situation in financial markets and tighter financing conditions. But it also has to do with the first signs of doubt in the minds of investors. We're all familiar with the term greenwashing, which is a problem that is very hard to erase. It's still very much there. So there are important developments such as the introduction of new sustainability reporting standards and taxonomies to define better what we really mean with sustainable investment and sustainable finance. So a lot is being done, but still much more can be done. In addition, another critical aspect of sustainable finance is that while the funds being raised in global capital markets are, of course, a very positive thing, these global capital markets are almost all in developed countries. And if the funds are also being invested in these developed countries, it doesn't help the global south to a large degree, right? And that is why we don't see the same positive trend in sustainable finance in SDG investment. So that means that while the mobilization of capital is still moving up, the channeling of that capital to where it is needed the most is not really happening to the degree that we need it.
Okay, and SDGs are obviously sustainable development goals. What fundamental changes do we need, Richard, in the how, the where and the why of investing to ensure that there's a more inclusive economy? How do we find that right balance at the moment when there are obviously so many priorities?
Right, that's a very good question. The where and the why of the investment is a really important point. What we see now is that, of course, a lot of investment goes to the more developed countries. A lot of investment goes to the large emerging markets, but there are many smaller and poorer developing countries that get very little investment. If we look specifically at the type of investment we need for the Sustainable Development Goals, at the type of investment we need for the energy transition, there are still more than 30 of the least developed countries that haven't received a single investment project in renewable energy since the Paris Agreement, basically. If we look at the share that these least developed countries receive of investment specifically geared towards the Sustainable Development Goals, it is less than 5% of all flows to developing countries. So most of the investment flows specifically geared towards sustainable development is actually not arriving at these countries that need it the most. We really need to make a huge jump in progress on achieving the SDGs. Now, what needs to happen to change that? Well, some of these factors are structural in nature. They are obviously to do with the global financial architecture. They're obviously to do with the cost of capital in these developing countries, which is very high, with high risk perceptions on the part of international investors. So those are things that developing countries on their own can do very little about. But there are things which developing countries on their own or as a group can affect. They can work on improving these risk perceptions by addressing weaknesses in governance and institutions. And there are things they can do as a group in a either South-South context or at a regional level to improve the type of investment flows in regional value chains through regional industrial development and through regional projects to promote investment in energy infrastructure, for example, for the transition. It's not all in their own hands. We need to work at the international level on making sure that we maintain an open investment climate to allow those flows of capital from developed countries and where money is being raised in financial markets to the developing countries. But there are also things that developing countries can do on their own or as a group.
With the UN Trade and Development 60th anniversary happening this year, what do you hope will be achieved in the next 60 years?
Now we're moving from an open investment climate from which many developing countries have benefited significantly to kickstart their development, to one where the investment environment is getting more closed, where it's more difficult to attract investment, where there is more competition for investment, and especially of the type of investment needed for development. So if we think ahead the next 60 years, my hope is that that move towards less openness to investment is stopped and reversed again, so that we get an environment where developing countries can continue to benefit from FDI to kickstart structural transformation and industrial development, where development is spread more equally, not just to the rich and the big countries, but also to the rest, and where the benefits of that investment are also spread more equally.
Well, here's to the next 60 years then, Richard. Thank you so much. That was UN Trade and Development's Richard Bolwijn, who was this week's guest. Tune into the weekly Tradecast next week and every week for more insights on the most pressing issues around the world of trade and development. And there's even more on our website, UNCTAD.org. I'm Sarah Thoms in Geneva. Goodbye for now.